Some comforting news for the markets came out last evening. One is the CPI retail inflation for India, the other is the CPI retail inflation for the US. US inflation, after hitting an all-time high of 9.1% in June 2022, has gradually come down to 6.5%. This was the lowest in a year. Now, India's annual retail inflation came down to its lowest level in a year too and remained within the central bank's comfort zone for the second straight month. Now, keeping the US aside, let's focus on India's numbers to see what factors contributed to the moderation. India's retail inflation fell for the third month in a row in December, coming in at 5.72%, below the consensus estimate of 5.9%. When we look at the breakup of inflation data, it shows us that the recent decline has largely been driven by lower food inflation. But inflation remains elevated in core inflation, which excludes volatile components such as food and oil prices. Clothing and footwear, household services and goods, and education have all seen a sequential uptick. Now, according to analysts, the continuing pass-through of input costs by producers and healthy demand for services suggests that core inflation is likely to remain a pain. Now, it looks like the extremely high inflation readings that dominated the first half of 2022 are moderating. This increases the likelihood that pricing pressures can subside further without causing too much economic pain. Now, though the overall CPI inflation is on a declining trend, core CPI continues to be a pain point. While India's retail inflation came lower, we also saw a rebound in the country's industrial production to a 5-month high. Index of Industrial Production Data, or IIP, is an index that tracks manufacturing activity in different sectors of an economy. Now, core sector output, which we discussed last week, contributes to about 40% of the IIP. The IIP slipped into a year-over-year contraction in October 2022. In November, IIP rebounded to 7.1%. While the strong rebound was on the back of a favorable base effect, the growth was also supported by festive season demand, which led to strong sequential growth across sectors. The chart on your screen shows us that industrial output registered a broad-based improvement across sectors and use-based segregation. Now, mining, electricity, and manufacturing all saw an uptick. Going ahead, it will be critical for the current growth momentum in the industrial sector to be maintained. However, weakening external demand will remain a drag for the industrial sector. As a result, maintaining domestic demand becomes even more crucial in times like this. Now, healthy credit growth and declining inflation in the economy will likely support domestic consumption demand, but the industrial sector will feel the pinch of a global slowdown. So what does this news mean for you? We keep our reservation on the inflation outlook as there are several factors driving it. However, downward pressure on commodity prices and supply constraints easing have helped tame domestic inflation. But concerns around core inflation still remains. This will have an indirect neutral impact on you. Industrial activity has picked up on the back of a favorable base effect and festive season demand in November. However, the weakening of external demand and the uncertain global environment could be major challenges to the momentum of industrial activity. This will have an indirect neutral impact on you. While I say this is me, Merlin Susanna, signing off. Take care and stay invested.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.